The National Economic and Development Authority reaffirms its commitment to keeping inflation manageable following its drop to 2.1% in February, the lowest level in 5 months. This slowdown provides relief to consumers and businesses, potentially giving the Bangko Sentral ng Pilipinas more room to start cutting interest rates sooner. But with food prices, global uncertainties, and oil fluctuations still in play, can inflation remain stable in the months ahead? Here to provide insights is Aris Dacanay, ASEAN Economist at HSBC in Hong Kong. Hello, Aris, and welcome to Business Brief.
Hello, thank you, Rain. Thank you for having me. Hello.
We appreciate you joining us. Let's start with the freshest economic data out of government for a minute. 500,000 more Filipinos are jobless. That's 4.3% higher unemployment for January. Is this a seasonal drop, or is there more to be worried about?
You are absolutely correct. I do think it is a seasonal drop. If you look at the unemployment rate back in January 2024, it was at 4.5% compared to 3.1% to the previous month, which was December 2023. So it's a bit of a deja vu. We had a 3.1% unemployment rate last month, and at January, we are now at around 4.3. So yes, it is highly seasonal. The Christmas season builds jobs, and when the Christmas season is over, the gig economy kind of looks away for another way to earn more income.
All right, understood. On to inflation now. February, of course, slowed to 2.1% year on year. That's below or better than market expectations and the lower end of the BSP's 2 to 4% target range. Now, given this trend, how does this change the outlook for the BSP's policy moves this year?
I want to qualify that statement. It is not just a below market sentiment. It is much better than what the market and the BSP expected. The BSP had the forecast range of 2.2 to 3.0%. And as you mentioned, it came at 2.1%. As the government market interventions on rice supply and as global oil prices coming down has filtered through the economy and has represented itself through lower prices. Now, with inflation done, or with inflation out of the way, I do think the BSP has a larger room, more room to cut interest rates, even perhaps cutting interest rates regardless of the Fed. We do know that cutting interest rates would narrow its what you call the interest rate differential with the Fed, and it can risk more volatility in the currency. It risks devaluing the peso, maybe perhaps to a 58, 59 level. But regardless of that, we can absorb the inflation shock at 2.1%. There's a lot more to go before it breaches 4%. So whatever inflation being caused by, let's say, a devaluation of the currency, depreciation of the currency, I think the Philippines can take the blow.
Understood. Well, meanwhile, the BSP also decided to hold its benchmark rate steady despite easing inflation. Should the central bank have signaled a rate cut sooner to support growth, or what are the risks in delaying monetary easing?
I do think that's what the BSP did suggest. The BSP suggested that, hey, we're going to pause interest rates right now. We don't know what's happening in the global economy. Yes, we had a picture just yesterday on what the tariff policies are in the US. But during that time, during that first rate setting meeting, nobody really knew what would happen next. And that's the reason why the BSP decided to, you know what, let's keep it a pause. We don't know what's ahead. There might be volatility in the FX market. So let's hedge that risk and keep that rate steady, but then signal to the market that there is still more to come. The pace, however, is a bit uncertain. We do think it's going to be gradual. The easing cycle will be gradual to keep the peso stable. But then again, I do think the BSP is ready to rebalance the risks in a way that we cut interest rates to help prop up investment, to help prop up household consumption, but at the same time allow some depreciation, allow some inflation in the economy, mainly because the economy can take it. It's a balancing of risks.
And I understand from your recent report that you had actually taken a look at each of the segments or industries in the economy, the services as well as manufacturing sectors. What kind of insights can you share with us there?
So I think we have to pull the Philippines out and compare it to other ASEAN economies. So if you look at the exchange rate or the peso against the other currencies, the baht, the ringgit, the rupiah, ever since 2010, the Philippines has always been the outperformer, meaning the peso is more often than not stronger than these other currencies. Now, there are trade-offs in this kind of scenario. If you have a stronger currency, that means we are able to purchase our imports at a less expensive price. It's less expensive for us to buy the goods abroad, but it's more expensive for foreigners to buy the goods that we produce. In contrast to, let's say, Malaysia and Indonesia, which has a weaker currency than the Philippines, it's cheaper to buy a good that is produced in Indonesia as compared to the Philippines. So there is a trade off here. If your currency is strong, you get to import more products, but at the expense of local manufacturers having a more difficult time expanding its markets abroad. Now, with the dollar exhibiting strength, with the risk of the dollar becoming even stronger, I do think the BSP can turn this challenge into an opportunity by cutting interest rates further, boosting credit, allowing some depreciation, and help our tradable sector, our manufacturers, to be able to compete with its ASEAN neighbors and be able to export more. Now, there's one thing that I think needs to be maximized, an opportunity that needs to be maximized, and that is services. Services, as we speak, is growing more than the double digits. Quarter on quarter last year, I think from the last quarter, I think it grew by 10%, which is huge on a quarter on quarter basis. It's mainly because services has become more tradable thanks to the internet, thanks to the digitalization. It's easier for us Filipinos to work from home, work in the Philippines, but still provide our services abroad. So it has become more tradable. To keep the services sector more competitive, we will depreciate the service providers will benefit from the fact of from a weaker currency as they are able to sell their services at a cheaper price abroad.
It's a great insight there as well as, but there is a caveat, isn't there? There is the BPO sector that might get a hit or take a hit from recent developments in the U.S.
Um, for the BPO sector, I would say that it is more of an opportunity rather than a challenge, mainly because the BPO sector, or basically services in general, there's no such a thing as a tariff on services. It's hard to put a tax on the internet. It's hard to put a tax on the digital space. And with goods subject to tariff risks, but with services not so much, there is this tendency, or at least what we're seeing in the global trends, you have a lot of these investors shifting their investments from investing in manufacturing to investing in services. And that puts the Philippines in a good position because, like India, we are our comparative advantage, or at least what we specialize on, is on services. So we do expect that yes, investment in the goods sector, in manufacturing sector, might be a little weak with uncertainties over trade, but we do expect investments in services to improve, and the Philippines can ride that wave if it becomes more competitive, and to become more competitive, it helps to have a weaker currency.
All right, that's a good call to action there. And of course, taking your major recommendations on the peso as well as some insights on the Fed, you're saying that the peso remains one of the most overvalued currencies in Asia, yet the BSP continues to defend it through rate policy and interventions. You recommended the BSP, quote, let it go of the Fed, or let go of the Fed, like a decoupling. How would allowing the peso to weaken and narrow the rate gap with the U.S. Federal Reserve be a better strategy for growth? Do you have a peso outlook for the end of the year?
We do think the peso will weaken come the second half of 2025. But I want to add to that statement. So it's not just let it go. It's not just let go of the Fed. It's let go of the Fed and follow ASEAN. So let's compare it to a scenario where we do not let go of the Fed. If we keep interest rates steady, but everyone in ASEAN continues to cut interest rates. Now, in that case, the peso will remain strong, may perhaps appreciate to a certain extent, but the currencies, let's say the rupiah and the Thai baht, may see their currencies devalue. Again, in a hypothetical scenario. Now, if these currencies depreciate but the peso remains strong, it's cheaper to spend your vacation, say in Bali, in Koh Samui, as compared to, let's say, Boracay, because with your $1, you can exchange it with more rupiah, with more of the baht, but less of the peso. So you have a lot of these tourism demand, perhaps slightly shifting and choosing Thailand and Indonesia over the Philippines. So to be able to remain competitive in a very competitive export environment, more so with tariff risks rising in the world, it's good to keep your currency weak to follow ASEAN's easing cycle to ensure that your peso remains competitive and you do not lose market share in exports, particularly both goods and services.
I can understand some entrepreneurs heaving a little bit of a sigh of caution right there. But let's touch on the RRR for a little bit. The BSP recently cut the RRR by 200 basis points to 5%, injecting about 382 billion pesos into the financial system. But as seen is in the previous RRR cuts reflected in your report, the BSP often absorbs this liquidity back through its monetary tools. Will this move meaningfully stimulate lending and growth, or is it largely symbolic?
So with 382 billion, I have to say most of it will be reabsorbed by the BSP. A part of it can filter through the economy. If you look at bond rates today, it's higher than the BSP's facilities. So I do think a portion of the 382 may turn into bonds, which of course would stimulate the economy further. But in totality, I do think the BSP will just reabsorb it. Whether it's symbolic or not, I do not think it's symbolic. Or at least I do not think it's just symbolic. Because if you cut the triple R and cut interest rates moving forward, each cut will be more impactful to the economy. You're basically charging each rate cut moving forward to be more powerful than before because you're able to lend more money at a lower interest rates, therefore fueling the economy, lowering debt services, boosting household consumption, and of course, boosting investment.
Well, given the current economic trajectory, Aris, where do you see the Philippine GDP, inflation, benchmark interest rate, and RRR by the end of the year? Are there key risks or opportunities that businesses and investors should watch out for?
So, in terms of the triple R, I do think we need to hear more from the BSP on what their plans are ahead. It is in totality a policy decision. So we have to hear more from what the BSP is saying. In terms of the policy rates, I do think, and this is quite a strong view, I do think the BSP will cut interest rates by 75 basis points regardless of Fed action. Again, the move now is to let go of the Fed but follow ASEAN instead to make sure exports in the Philippines remain competitive. In terms of inflation, we saw it just yesterday. Inflation surprised to the downside. I've been the most dovish in the market. I do forecast that inflation would be around 2.5% for the full year 2025. That forecast remains the same because, as you know, rice prices still have room to go down. Global oil prices will likely remain steady as with the US policy of boosting more supply in the global economy. And for growth, I do think the Philippines can still grow above 6%, mainly because it's insulated from tariff risks. Its comparative advantage to the rest of the world is services. And as mentioned a while ago, services is growing by more than the double digits. And it is not subject to tariff risk whatsoever. The only important part to make sure that we're able to grow above 60% is that we're able to boost the domestic economy, particularly through consumption and investment. And the way to do that is to cut interest rates.
All right. Finally, global uncertainties. We have investment outflows as well. A lot of people concerned there and mixed policy signals. What for you might be the biggest driver of Philippine economic growth in 2025? You already mentioned services and tourism. And what do you see as fitting into the BSP's picture?
I think we've already mentioned it. We have a large services sector economy, but let's paint that a little bit further. This services sector economy is largely the gig economy, and it's a lot of educated, but educated workers in an informal setting, and a lot of it. And I like to point it out. There's no word for it yet, but it's the back end supply chain of content creators. You have a lot of these famous content creators in the US. Of course, they produce content every day. That's a lot of work. You have to edit videos. You have to manage, let's say, your Instagram, Facebook, social media account. And a lot of and a lot of the quote unquote staff that supports these content creators, they're actually located in the Philippines. You have video editors, you have AI managers, again, social media managers, and it's an economy today, given the fact that we're transacting more online. It's a booming economy in the global world. If you see the jobs data in the Philippines, more than 3 million jobs were created in the digital space. So what's going to drive the economy moving forward, or at least in the next 2 years? You have digitalization, you have the Philippines' robust and English-speaking labor market, and of course, our hospitality to the rest of the world.
Hopefully government will gear towards more of content creation then and those back-end services sector. We appreciate you joining us today. Aris Dacanay, ASEAN Economist at HSBC in Hong Kong. Pleasure to speak with you today. Grateful you could make time for us. We appreciate the insights and recommendations. Until the next time.
For having us.